afternoon and welcome. My name is Doug Dean, the owner and managing partner at Schaeferts and Dean, and we're proud to bring you the April 2023 installment of our Business Builder Speaker Series. We hold these the third Wednesday every month at 1 p.m. This was a brainchild born out of the COVID days when we couldn't get together, and our idea was every third Wednesday of the month at 1 p.m. we'd host a session and we'd bring on a speaker that we thought would have good value for you, the real estate agent. Uh, Good content for an hour. We do record our Zoom conversations and we'll make them available on our YouTube channel, and you'll receive a link to it so you can always go back later and revisit the material that we've covered. I want to thank you for giving us your time today. We know that you're busy and we appreciate you coming to join us and sharing your time with us. To make the best use of your time, we encourage you to ask questions and to participate utilizing the chat box. Before I introduce this month's speaker, I'd like to tell you to mark your calendar for May 17th. That's the third Wednesday in May from 1 to 2 p.m. Our guest will be Steve Hanley with Georgia Pine Home Inspections on the importance of having a home inspection to avoid costly repairs. So be sure to tune in next month, May 17th at 1 p.m. And this month, I'm proud to introduce to you my friend Tim Arrington, president of Mortgage Corps. I heard him do a presentation at a realtor's sales meeting talking about a number of zero and low down payment options. And I said, I think this will be a great topic for our audience. So I'm pleased to introduce Tim Arrington, president of Mortgage Corps. Tim, I'll let you take it away.
Okay. Hello, everyone. Thank you, Doug. I'm excited and honored to be here. Hopefully we can have some fun in this next hour and share some good ideas, and hopefully it'll be beneficial. So my name is Tim Arrington. I'm with Mortgage Corps. I've been in the business for approximately, now I get these slides on there, for approximately 25 years. So we're a broker. What a broker does is a broker is going to allow you to shop around and get the best rates, the best programs. A lot of times there's a confusion between, as a realtor, whether you're dealing with a bank, a correspondent lender, or a broker. I've been in all three different channels. And currently, for the last 2.5 years, I've owned a Mortgage Corps, which is our broker shop. Okay. Some of the real quick advantages between a banker and a correspondent lender is with a broker. Like I said, we can shop around. We currently have over 20 different investors that we can choose from because every situation's different, every loan's different. This way we can make sure that we're matching the best loan program with the borrower. Okay. The second thing, and probably the biggest thing, the difference between a broker shop and a bank or a correspondent lender is pricing. Super aggressive on pricing. Normally with a broker shop like mine that's priced low, you're going to save somewhere around a point and a half on interest rates for your clients. Okay. And I mean, we really, if you look at our Google reviews, we do everything we can to make sure we're providing excellent customer service and quick turn time too. There used to be, I think, a problem where brokers were considered to kind of be out of touch, but there's been a lot of money spent in the broker channel. Speed to close is better or as good as any correspondent lender or bank. Where normally, I close loans often in 10 days from the time I get a contract. So a broker is a good vehicle and a good way to look at it. All right, so what I'm going to do a little bit here is I'm going to talk about a couple different things. We're definitely going to get talked about some DPA, down payment assistance programs, some other loan programs, but I want to start out just talking to you about the pre-approval process, because I think it's important for agents and referral partners to understand what it is that I look for and other lenders look for when they're pre-approving a borrower. Okay, so the first thing is I basically break it down and say, if somebody calls me and says, hey, I want a loan, what are your rates? I'm like, it really depends. The rates can be anything you want them to be. but let me kind of explain it to you. So I just say, I'd say, here's an analogy. To get you pre-approved, so I can know how much you can qualify for, what's your monthly payment estimated, and what's your estimated cash to close, I'm really looking at three things, three different buckets, okay? So bucket one is the credit score. So we need at least a 580. If I can have a buyer, a potential buyer that has at least a 580 credit score, pretty good chance I can get them a loan or get them pre-approved, okay? There's some investors out there that'll go down to as low as 500 score. But if you have anything like that where they're going below a 580, usually they're going to want to put more money down. They're going to at least put 10% down, okay? So the three buckets, let me go back here. The three buckets are your credit score, your DTI, your debt to income, and the cash to close, okay? And each one of those buckets really tells me the amount they can qualify for and what problems or future problems they could have as far as getting to the closing table. Okay, so credit. Talk to you real quick about credit. There's a lot of misinformation. Usually that's the toughest thing, is to get somebody to say, go ahead and pull my credit. Everyone has just been programmed over years that any credit inquiry is going to negatively impact their scores. But that's not necessarily the case at all. It used to be. They've changed some rules. So there's a big difference between a hard pull and a soft pull. So normally somebody will call me and say, hey, one of my first questions is, hey, do you have an idea what your score is, what your credit score is? And they'll say, Credit Karma or MyFICO or Experian says it's, 630. Well, I immediately say, hey, there's a little bit of difference between what I look at as a lender and what Credit Karma does. Credit Karma, nothing against Credit Karma, but they're there to sell a service. They're to sell credit cards, okay? What we're doing is a true hard pull, so it's calculated a little bit differently. It's usually, not always, but usually slightly less than what they would see on Credit Karma. For Credit Karma, for one thing, they're looking at just one bureau, sometimes two bureaus. We're looking at all three bureaus and taking the lowest, the middle lowest. So if there's two borrowers and there's 6 scores, the Experian, TransUnion, Equifax, on both the bar and the co-bar, we're taking the middle lowest. If there's only one bar, we're just taking the middle. So that's the score we use to credit qualify them. And then often, I'm serious, the hardest part of getting somebody comfortable and ready to complete an application is, hey, is this going to hurt my credit? So they came up with a rule about a year and a half ago, that says you can get a mortgage pull, okay? And it's identified as a mortgage pull. This doesn't work for car credit pulls, but just mortgage pull. It's identified as a mortgage pull. And in a 45-day window, you can have unlimited pulls. So it's not going to negatively impact their scores for at all. The first one does, but any after that within a 45-day period counts as one pull. Okay. But we just came up with a new program, and I'm loving it. It's a great program. Basically, it's called a pre-qual report. Pre-qual report allows me to pull a credit. It's a soft pull. I mean, it gives you all the same information as a hard pull, but it doesn't register at all with them. It identifies as a soft pull, which is good because then there's no trigger leads. And if you guys know what trigger leads are, trigger leads is where the credit companies sell that credit report or that individual's name and information to many different people. So as soon as someone's credit's pulled, then another lender or another broker may be getting that same information. There's ways around it, but not all of them are foolproof. So with this soft pull that I'm been using now and super excited about, it doesn't initiate any trigger leads, which is a good thing. And then I can advise my bar during that time period, hey, go get on the do not disturb list or opt out list. So even when we do pull a hard pull, no one it won't initiate any trigger leads. So again, I'll go back to credit. Most investors are looking for a 580, okay? 580 or greater, we can probably work with. Less than 580, they're either going to need some credit repair, which we do a lot, or they're going to have to put additional funds down. So credit score is one. That's bucket number one. What is your credit score? A lot of people, they don't know, or they're scared to get it pulled. Now with this type of credit pull, that won't be an issue, okay? Second thing I utilize is, and the most important really, is your DTI, the debt to income. So that's really what banks or lenders use to determine whether you can get a loan and how much. So on the debt to income, that bucket, what we're going to do is we're going to add up all the consumer debts, student loans, car notes, other retail, other real estate owned, alimony, child support, whatever their total debts are that show up on the credit report. Now, alimony and child support would not show up on the credit report, but the other ones would. So whatever the monthly minimum payments, then I'm going to add the new housing payment. So we're going to look at the consumer debt plus the new housing payment on a PITI basis, principal, interest, tax, insurance. So we're going to come up with their total debt. Okay. But that's an all encompassing number. I mean, that's what is all their debt? So the debt is anything that's going to continue for at least 3 years. Okay. So if they had to pay child support, if they had to pay alimony, and it didn't continue for 3 years, then I didn't have to count it for their income, or I don't have to count it for debts. For example, student loans is a big one right now. So a lot of people out there have student loans. So each agency treats student loans a little bit differently. So if you're looking at conventional, or conforming Fannie Freddie, they're going to look at 0.5% of the balance. So if it's in deferment and it shows 0, or if it's in some kind of income-based repayment plan, for both FHA and Fannie, it's 0.5% of the balance. Okay, for Freddie, it's 1% of the balance. So whatever that is, if they owe, $30,000, right, then it would be $150 a month counted against that debt load for 0.5% for Fannie and for FHA. Okay. DU, we're looking at, so from the debt, I'm just adding up all that debt, and I'm going to divide it by their good income, the income before taxes if they're W-2'd. And here's the big kicker. This is what hurts most people. On a self-employed, whether you're Schedule C, 1099, S Corp, it's a 2-year average of that income. So a lot of people think, hey, well, I'm 1099, I drive a ride share, or I drive Uber, or, whatever. I made $100,000, but on line 31, after expenses, they only show 40. Then that's the number we're looking at. We're looking at a 2-year average of their net proceeds, basically their proceeds less deductions. Now we can add back in your depreciation, we can add back in mileage. There's a few things that we can add back in, but we're trying to come up with a debt to income ratio number. So conventional, you want to be in that 45, 46. FHA, they'll go up as high as 55, 56 usually. So it's the total debt divided by the income, and that's really the magic number. A good rule of thumb is if you're out there showing potential buyers homes, and I know it's a little bit of an awkward conversation, but somehow if you can get a general idea of their income, then about half of their income is what they can have in total debts. So, if they're making $60,000 a year, and that would be $5,000 a month, their total debts really cannot exceed around $2,500 a month. So if you're showing them a $500,000 or $600,000 home, it's probably not going to happen unless they have somebody else that they can put on the loan. So really, out of the 3 buckets that I use as an analogy, bucket 1 being credit, bucket 2 being debt to income ratio or requirements, the detail is where it's at. I mean, because that determines a hard stop at 50, because we run it through our automated approval engine. And if DU or LP comes back and says, no, it doesn't work, there's not a whole lot we can do. We can pay off additional debt, but either reduce our debt or try to get more income. And the usual way to get more income is to add somebody else to the loan. So that's a kind of one thing I did want to say is Fannie has DU. So when we work on everything, we run it through the automated approval engine for desktop underwriting, they need a 2-year average. And it cannot be declining either. Like, so in 2021, they showed they made 100, but in 2022, they showed they made 80. They're probably not going to get it approved because it's a declining income. You want it to be, year over year inclining, not declining. If you go with Freddie, they use a thing called LP for desktop underwriting, and that's only a 1-year look back, which is very popular. But what a lot of LOs they forget to mention is that it's the 1-year look back is only if they've been in business and can document they've been in business 5 years. If they can document they've been in this business 5 years, then they can do a 1-year look back. And then the third bucket is your cash to close. Okay, so we looked at credit score, we looked at our debt to income ratio, and then third is your assets. Where's that money coming from? So very important that the money for the cash to close, we have to see it where it's coming from. So, we need to make sure that the buyer did not go get a loan to get this loan, because if they did, I would have to include that debt into their debt to income ratio. So that's important. Needs to be sourced and seasoned. Like, for example, season is if somebody just got gift funds or just got some money, right? And it really was cash and they couldn't really source it. Well, they need to go ahead and get it in a bank account. So when they show me 60 days of bank statements, I won't see that deposit on those bank statements. So that's basically season it. Season it because I'm going to need 30 days of pay stubs, and I'm going to need 60 days of bank statements. But if I don't see a large deposit, then I don't ever have to source it. So those are some of the ways that I consult and advise potential buyers to help them through the process. But the assets is probably the number one problem with getting somebody approved, is that they'll provide the bank statements and there'll be a large deposit on there. We have to source it and it becomes an issue. So usually you can work around it and figure out a way to make it work, but that's always an issue. Okay. Before I go on the next slide, I went through that pretty quick. I just wanted to kind of give you a little bit of what a lender and a broker in this case looks for in qualifying somebody for a loan. Okay. One thing, I'm looking through my different slides here to remind me. So income needs to continue. I think I said this for 3 years. So if we're any kind of income they're getting, whether it's SSI or disability or alimony or child support, if it doesn't continue for 3 years, then I cannot count that. And I'm going through this quick. Okay, here's another good thing that I wanted to mention, because a lot of people are not, there's so much information out there that it sometimes gets overwhelming. So I kind of wanted to just break down and make sure you guys are aware of the different loan providers. So if you ever heard the term conventional, conforming, agency, they're all basically the same. That's either Fannie or Freddie. So if somebody says, I'm going to do a conforming loan or I'm going conventional, it's usually Fannie, Freddie. It's a traditional, it's following Fannie, Freddie guidelines. We're looking at income. We're going through the whole thing I just mentioned. So that's when you hear conventional, traditional, agency, that's all that. Government, just like those really, but instead of being insured by a non-government agency like Fannie and Freddie, then government loans, FHA, VA, USDA, great loan programs. They're backed by the government, insured by the government. So that's your other source of loan providers. So you have really, your agency and your government loans. Then you're going to hear a lot now about like non-QM loans. Non-QM, you probably hear that term and you're not quite understanding. So it stands for non-qualified mortgage. So in order to deliver a loan to the agencies, whether it's Govy or Fannie Freddie, it has to be a qualified mortgage. It has to be a qualified mortgage, but there's a whole segment of private lenders and banks out there that hold their own paper and don't sell the loans to Fannie Freddie initially or go through government. Those are called non-QM. They don't have to follow agency guidelines. Some popular loan programs in there are like the bank statement loans. They're gaining popularity. If somebody has a trouble qualifying on using regular income, we can look at a 12 or 24-month bank statement program and take in the average of the deposits to qualify. Okay. Another real popular non-QM loan is DSCR. Okay. debt services coverage ratio. So that's more of a loan program for investors. It's a great loan program. So instead of an investor, and it's only for investment property, but instead of an investor having to provide 2 years of tax returns, maybe they wrote off too much, whatever, they can use a DSCR. And what we do with the DSCR loan is we go out there and do a rent comparable of the property they're buying. And as long as that rent that's coming in is higher than the PITI, the monthly payment of that loan, then no income documentation is required. They'll just use that rent comparable as documentation of income, because they know if this loan was to default, they at least have that they can count on if they had to take the loan over. Other popular non-QM loans are like the I-10 loan, the tax ID, it's called I-10, tax ID number. That's really popular, especially as more Hispanic and Latino buyers are coming to the market. That's a program that we're offering and a lot of different brokers offer, and it has its advantages. Asset depreciation is another non-QM you may hear about. That's like, hey, I don't have income documentation. I'm not looking for an investment. I'm trying to buy just a regular home and I don't work. I retired early, but I got a ton of money. I've got, $2 million or $1 million in the bank. Then we can just take his assets, divide it over a 36-month period and use that for his income, as long as it continues for 3 years. Okay. And then the last money or loan provider you'll hear out there is hard money loans. A lot of times flipping homes. So hard money loans, there's a different lender. Most traditional lenders like myself that work within the residential retail space, they're not going to offer hard money loans. It's just a different thing. They don't go through the same compliance or testing, but there's a niche and a need for that too. But usually what you can think of, starting at agency and going down, agency and government are going to give you the best rates. It's the most secure loan. So it's definitely going to give you the best rates, but it's going to be a little bit tighter to get approved. Non-QM is going to give you a better rate. So right now on an FHA loan, I'm probably at about 5.5% on a 30-year fix. Whereas on an agency, maybe we're at mid sixes. Rates are up a little bit. Non-QM is probably going to be 1.5 points higher, maybe 2. So if I'm at mid sixes, you're probably at mid eights on any kind of non-QM loan. Plus, you're going to have to usually put more money down. As you move down the scale of the different loan providers, is a little bit more in the interest rate, and then also more money down. There's some caveat that they're going to ask for to minimize their risk. Nobody's just giving a riskier loan the same rates as a agency loan. And then hard money loans, you can almost add 2% to non-QM. So if we're at 6.5 on conforming, then non-QM may be 8.5, and then hard money loans, we're probably at 10.5. So that's just not always, but that's just kind of a rule of thumb. Okay. Having so much trouble. All right. I went over a fair amount there. Is there any questions? No.
Hey, Tim,
Okay.
I got one. This is Jason Fleeman. So,
Hey, buddy.
The
How you
loan stuff,
doing?
doing well. The loan stuff, there is a lot of stuff out there. And last night we talked a little bit about the 10% down on the investment property, because that's really a big piece. I mean, I've got a lot of investors that if there's like no HOA or no rent restrictions, they're looking at wanting to do some buy and holds or whatever. So can you do maybe a little bit deeper dive into that, 10% down, and it's only got to be $1 over the mortgage? Because I mean, that's a huge piece for people wanting to invest. I mean, is there a limit on how many times somebody can do that?
There's not a limit on how many times you can do that. And every investor, Jason, is a little bit different on their DSCR. But and I can go in and invest and we can get in more specifics, but yeah, some of them are going to, some of them are going to limit you to say, hey, you have to put at least 90% down. Some are even go at 80 or 85. They're all a little bit different. The more money you have put down, definitely your rates are going to be a little bit better. Some will let you go to 100% or 100 more, even if the rent is less than what the monthly payment is. If it's only like 25% less, they'll still allow you to do it. So each one of these, not having to go to Fannie or Freddie, each one of these non-QM or these private banks that offer these DSCR type programs, they can pretty much write their own guidelines. So it's hard to just say, hey, I've got this one program. But what I do know, I've done several, and what I do know is they're fairly easy, because normally what the sticking point of any loan is to make sure that they credit qualify, which you're still going to have credit qualifying, but then your DTI works, your debt to income works because of your income and your debt. But if we already take that off the table, they don't care what the DTI is. They don't care what the DTI is. They don't care what the income is. They're just solely using that rental. And it's not all 10. Some of them are 10 is probably the minimum you can put down, where some of them require 15 and some of them are 20. But yeah, I mean, definitely a hot item right now in the non-QM market.
Well, I mean, even if there are 15, I mean, so because a lot of them are 20, 25 when you go through like a conventional type. I don't know if I want to use conventional, but you know, a typical loan is like 20, 25% down to do an investment property. But I mean, even if it's 15% down, that's still pretty good. But how much more, again, I'm not holding you to it, but how much more is the rate?
That's what I was saying. If you think about each one of these loan providers, that's kind of why I wanted to talk about that. Why I'm having so much trouble. These different loan providers, you can kind of figure that almost like 2-point increase. So if I'm at 6.5 on conventional Fannie Freddie, and then we go to a non-QM, you're probably in that 8.5, maybe 9 range. Probably 8.5. Depends on where rates are set. You know, they're moving every day. So about 2 points higher than what you can get a conforming for.
But like we kind of talked about last night, that I mentioned that the rate doesn't really matter if your rent income is $1 more than the mortgage. It could be 12%. But
Exactly.
but if you're making $1 more than the mortgage, it's still a somewhat sound investment, and you can always refinance it later.
Well, that's exactly how investors look at it too. So that's a great point. Is they're not so caught up in rates that because they'll just pass it on to their renters. I mean, they're you know, it is what it is. It's all part of their equation, I guess, and for their return on investment. You can speak to that more than I could, but yeah, I think that's how they look at it. They're doing it more for ease. Like, okay, I've got 8 properties and I don't have to provide you know, insurance and tax bills and you know, go through all that. I'm just going to add a new one and use a DSCR type program. So it's
I think that's a great program. You could probably do a whole thing on that.
yeah, there's a lot, and it's fairly new. I mean, I think it's been around for a couple of years, but over the last 6 to 12 months, 12 to 6 months, it's really starting to take up steam and it's everywhere. Now, this is the key, as it's just an investment property, right? But they, so in the past, this is funny, in the past, the biggest area for mortgage fraud was where buyers were saying, hey, this is going to be my primary residence, and buying it as an investment home, but saying it's their primary residence, right? Because we all know if you go conventional, if you buy an investment, you got to put at least 20% down, or, you know, you got to put more money down, and the rates are higher. The rates are higher on a investment property going conventional than they are on a single family residence, right? Or a second home. So now they have this reverse mortgage fraud where people are trying to take advantage of this DSCR and say it's going to be an investment property so they can qualify, but actually using it as their primary residence, which is kind of interesting because it's the reverse of what always happened in the past. In the past, people would say, hey, I'm about to buy this home. It's going to be my primary residence, but with all along knowing it was going to be an investment property. Now they're saying, so they can utilize I-10, I mean, it's going to be DSCR. They're saying, hey, we're going to buy this as an investment, but actually using it as a primary residence.
For those who aren't familiar with the term, DSCR is a debt service coverage ratio. Can you tell everyone just a thumbnail about what the DSCR means?
It's basically the debts. Oh, it's the calculation of the difference between the rent comparable when we do a 1007 appraisal versus what the payment is. So we want that DSCR ratio to be 1. So basically your rent, okay, and your monthly payment are close to being the same. Okay, or your rent being way higher than your monthly payment. That would even be better. The better the DSCR ratio is, the better your rates would be. They're not drastically better, but there's some addition or add-on charge if you go, if you go below a 1. So that DSCR, or debt services coverage ratio, is just a calculation of what your monthly payment is versus what the 1007 rent comparable says you can get on that unit, doing an appraisal, like say a 1 mile radius with similar type properties. So it's just a calculation. Did that answer that, Doug?
Yes, that's helpful. Thank you.
Yeah.
Hey, I had a question too. Could you speak more about the I-10 and what that would involve? And also, do you have Spanish-speaking mortgage people to help?
We do. Great question. We do have 2 Spanish-speaking, fluently Spanish-speaking. We have a couple others that try, but I don't know if I'd qualify them as Spanish-speaking. But we do have 2 loan officers that's fluent in Spanish. So the I-10 loan is, and I'll be honest with you, I haven't done a lot of I-10 loans. It's a difficult program because a lot of investors came in and got out of it. But instead of using a social security number, they are using their tax ID. So there's outside of that, there's no truly benefit. It's just that even if they're non-permanent resident alien and they have an I-10, a tax ID number, then we're able to issue them financing, opposed to having a social security number. So the kicker there, though, from what we ran into, is that as you move through the loan process, there's a lot of due diligence that's done on the back end of every loan. If they determine that a social security was used at one time with this particular borrower, then that's going to pretty much kill the deal. So it's basically, I've had a tax ID, I've only used a tax ID, and now I want to apply to a loan using this tax ID. It's just another form of immigration status that will allow us to provide financing.
Okay, because we do have some clients that have I-10 numbers, so never knew there was something specifically for them. So.
Yes, that's another hot product is the I-10. I mean, I could send out a mass blast and say, I've got I-10 loans and I can close them. I would have more work than I can handle. The problem is there's not a lot of investors that do it well. There's about 2 in the country, and they do about 90% of the I-10 business. It takes them, and it takes a little bit longer to close. That's another thing. So I want to mention, and I'm going to talk about zero down payment options and down payment and assistance here, is that a lot of times those loans are going to take slightly longer, not drastically longer, but if say right now, I think the average close time is down to about 22 days from start to finish. I know people still write the 30-day contract, but most of our loans close under 20 days, right? But if you're doing a down payment assistance, if you're doing a Chenoa, Georgia Dream, usually that's going to take slightly longer, maybe on an average 45 days. So that's just something that you need to be cognizant of if you're submitting an offer and our buyer is using some type of down payment, a land initiative, Chenoa. That's just information that needs to be known. Okay. All right, let's move forward. Was there any other questions? All right, so really, what's the hot thing going on right now? The hot thing now is helping first-time home buyers and underserved communities increase home ownership, helping borrowers who are basically knocked out of this market, finding a tough time to getting into home, ways in areas that that the agencies and other groups can help these first-time home buyers and underserved. So one of the big things is, okay, down payment assistance loans, right? So everyone's familiar probably with Georgia Dream and Chenoa, right? They're out there. Chenoa is actually having trouble right now. They used to be way more prevalent than they were. I think they're going through some funding issues. And this, I don't know who's been in this industry a long time, but there used to be a down payment assistance program called Nehemiah, which was a great loan program, but they dried up. They lost the funding. So a lot of these Georgia Dream and Chenoa and some of these Atlanta Initiative, they're great as long as they have funds. But if that funding dries up, they kind of come in and out as a viable product. Okay, so you know, traditionally, if you were looking to do you were a first-time home buyer. Let's talk about that first. If you're a first-time home buyer, you would probably look at putting the least amount of money down, which would be 3.5%, which would have been your FHA, right? So FHA was always known as the first-time home buyer program, because instead of putting the 5 or 10% down that conventional needed, you could put as little as 3.5% down. But over the last 4 or 5 years, that's changed, because you probably don't really realize this, but FHA and conforming, Fannie, Freddie, they're all kind of vying for the same borrower. They're all kind of in competition because they want, you know, they want to be viable. They want to be an entity that's here for the long run. So conventional came out and said, hey, we'll do 3% down. If you qualify from an income-based situation, we'll allow either Home Possible or Home Ready. These are 3% down Fannie products. So they're saying, hey, we can go as little as 3% down. And now it's not like, hey, you got to go FHA for first-time home buyer because you only have to put 3.5% down. But FHA is still kind of known as a first-time home buyer program because of the main reason is you go 3.5% down, you have a much higher debt to income ratio ceiling. So, you know, now that house prices are going up and monthly mortgage payments are going up, you want that higher debt to income to increase your borrower's buying power. So it's still kind of known as the first-time home buyer program, but they're even trying to sweeten the pot a little bit about that. So like, for example, FHA just reduced their monthly MI. It used to be at an 85 basis points. Now it's down to 55 basis points. So if I had two borrowers, if I had borrowed one that had a 660 credit score and had a ton of debt, you know, and their DTI was 55, 56, even if they had an 800 credit score, it would still be better to go FHA than go conforming. Because at conforming, first of all, they probably won't get it approved because of their debt to income's too high, right? Second of all, they're going to pay mortgage insurance on the conventional side, just like they're going to pay on the FHA side. So, and it's a better loan program. The monthly payments less. Everything's just as good on the FHA side, if not better, usually better than the conventional side. But agents don't like FHA. They don't like VA and they don't like FHA. And the main reason, I believe, I'm not quite sure because I think it's going to have to start changing because not everyone's going to be able to qualify for conforming conventional loan, is that more people or more agents need to accept FHA, but I think they're afraid of the appraisal requirements that they think, and it's not always the case, they think that the appraisals will be scrutinized more, that there's going to be more case for there to be subject to repairs. So I'm stating to the agents that are here on the call, be more open to accept an FHA loan. They're great loans, they perform well, and they're needed. So, but I have many loans that the guy could not go conventional and go FHA, and they have the hardest time on winning a contract, winning a home. So that's just the kind of difference between FHA and agency. So back to the down payment program. The program that I'm going to talk to you about is this SPCP program. This is Fannie's, and Freddie has one too, but Fannie's is the SPCP, the Special Purpose Credit Program, okay? And it's basically Fannie's first entree into really having a comparative or competitive down payment assistance program. okay? Because they know the Georgia Dreams, the Chenoas, the Georgia Dreams been around a while, but the Chenoas and some other ones, they kind of come and go as funding's available. So the agency is now coming up with this program, and they're rolling it out. Hope you can see that slide. They're rolling it out to only a select number of lenders in each state, okay? Doing a pilot program. So the key to this program for Fannie, this SPCP program, is where they're moving from. So depending on your zip code, okay, and it's going to be your lower income zip codes primarily, like maybe south and up the, south of the 85 corridor. It's not going to be in Buckhead. It's not going to be in Milton or those areas. But if they're moving from that, it's regardless of where they're moving to. It's all about the census tract they're moving from. If they qualify, okay, if one of the two bars is, and here's the eligibility requirements, has to be for primary residence, okay? It's only for purchases, not for refis. All property types of this eligible for the, so any kind of 15, 20 ARM, all that's fine, right? Excuse me, single family, condo, townhome, all that's good. But here's the bar eligibility for this particular, and think of it as a down payment assistance for Fannie, for the agencies, okay? So at least one of the buyers on this loan must be a first-time home buyer and have income at or below 80% of the AMI of where they're moving from, okay? That's key, 80% of where they're moving from, that's their income cannot exceed. So I'll tell you, it's about, income is about, depending on the county, but usually about 85K. So if they're making less than 85K, then, say they're making in the 70 range, they're going to probably qualify for the income requirement. And as long as one of them is a first-time home buyer, then what they're going to get is a $5,000 true grant. I mean, just they give it to them. There's no repayment. There's no second mortgage. There's nothing. You don't have to keep it for so many time. You could turn around and refinance. You get $5,000. You get a $500 credit to be used to a home warranty, and you get a $500 credit for your appraisal. So we, get the application, they complete an application, I pull it in, I look at their credit, I advise them. I'm like, this would be a good candidate for Fannie's SPC program. And then I run it through DU, and the DU or the desktop underwriter will have language that says, hey, this bar qualifies for SPC program. And when that happens, then I can notify them, and we'll structure the loan as such as where we'll just add the 5,000 as a credit. Now, the good thing with this too is, as most of you guys know, a seller can on a conventional loan, they can, contribute up to 3%. On FHA, they contribute up to 6%, right? But that is different. That's separate. That's just for closing costs and prepaids, where this 5,000 can be used in conjunction with that and can help lower the down payment. So it says here, Fannie Mae is offering a limited quality special purpose credit program on their Home Ready. Home Ready is Fannie's program. Home Possible Home Ready is Fannie's. Home Possible is Freddie's. To help more buyers with home affordability. This is available to qualified buyers who currently live in the specific geographic locations. So, there's kind of a back and forth between FHA and conventional or conforming on helping this market. They came out with a loan level pricing adjustment, Fannie did. So now if you're below this 80 MI, this is even not on this program, just in general, all loans. If you qualify from an AMI standpoint, and one is a first-time home buyer, and your score is below like a 720, you actually don't get hit for the lower credit scores that you did in the past. So you'll actually get the same scores, if not better, than someone that had a 700-800 credit score, if you meet the income requirements. So,
Tim,
yeah.
we've got a question. Can other DPA money be used alongside the SPCP?
No, they can't, because the DPA money is separate. You're usually going to go through a different, usually you're talking about Georgia Dream and that you're doing an FHA loan. It's very rare you're doing a conventional loan on your first. And then whether it's Chino or Georgia Dream, they're helping you with that 3.5%. So this is for conventional. You put 3% down, so you can use the $5,000 for that 3%, and then you can get seller concessions to help offset the closing costs and prepaids. But
All right.
I don't know with 100% certainty, Doug, but I'm pretty confident you would not be able to use a third DPA to minimize that any further.
And Tim, there was another question about minimum credit score for the various DPA programs, including the SPCP. What are the minimum credit scores?
Each one's a little different. So if you're doing a Georgia Dream, and I don't quote me on this, I think theirs is a 620. It's either 620 or 640. It's in that ballpark, right? If you're doing this SPC, it's whatever can get approved eligible. So there's not a minimum credit score requirement, but remember, this is a Fannie, it's a Fannie loan program, so you're going to run it through Fannie instead of FHA. So probably to be able to get the first approved, you probably will still need to be in that 620, 640. That seems to be the sweet spot. If you're much lower than 640, a lot of investors drop off. Once you get below 640, there's just not as many investors throughout the country that are wanting that paper. It's a riskier, slightly riskier, they believe it is. Statistics doesn't prove that out. So you're not as many investors. So usually in that 620, 640, depending on the investor, is the minimum credit score requirements for most down payment assistance programs. Okay. This is when we came out just to see if there's anything different. We say geo-targeted, same thing as census tract. If you're in a certain census tract, and the crazy thing about this, which I think they should have done a better job of it, is telling us what it is, right? What census tracts, but you actually have to run it and see if it qualifies. This does say a minimum FICO of 620, and I think they put that in there just because to get a Fannie loan, to get a Freddie, you're going to probably need at least a 620. This is just for first-time home buyers, single family. You can't have like 3 other investment property and take advantage of this SPC. It's clearly set aside to help lower served and first-time home buyers. Okay. It's a lot to talk about in a relatively short time, the different down payment assistance type programs, but there's a lot out there. There's the Atlanta Initiative. I'm not signed up with them, but I've heard good things about that program. Georgia Dream has been around. They actually give you more than just the 3.5%. There's cases where Georgia Dream will give you additional funds, but a little bit longer process to qualify. And, sometimes it's repayable. It depends on the loan program within Georgia Dream. And I don't want to do any disservice to Georgia Dream because I haven't utilized one of their programs in a while. Chinoa used to use a lot of those. That's a good loan program. It's governed and overseen by the Native American or the Indian Bureau. And it's a good program too, but for right now, not many investors are doing it. It's kind of doesn't have the funds. But just in general, FHA conforming, trying to get into it. There is a move this year. I think the key thing is to help that segment with home affordability. Because when house prices go up, it just makes it tougher and tougher. So I think all agencies, Fannie, Freddie, and conforming is trying to help out in that area, which is a good thing.
Tim, another question. Do you have any DPA grant programs?
Well, I think this SPC is kind of considered. There's another loan program. Grant to me means that it's just there's no repayment associated with it. They're just giving you that money. And most of the programs, except for Georgia Dream, are that way. That they're giving you what they can. There's another big one called Empower that a lot of people are using. that one of our investors, Equity Prime Mortgage, offers. It's a little bit different, but it's giving you the 3.5%. It's just granting or giving you the 3.5%. It's a good program. The problem with that one is the rates are slightly higher. So they're looking at probably about a mid-7 on their rates. But it's true, they'll give you that 3.5%. The bad thing with that loan program, which is that it's borrower paid, meaning the lender who originates the loan is still going to charge points to get that loan program. So, right now there's a lot of different, I would probably close it with this, or, there's a lot of good loan programs and there are new ones coming on board all the time. You really almost just have to say, hey, listen, we need this buyer needs down payment money, down payment assistance, and let your mortgage broker or your lender work on your behalf and get you the best loan program out there. So, because there's so many different, credit score requirements or income requirements and different pluses and minuses to what make the loan programs work. So.
And Tim, I think you touched on this earlier, and I think you shared it as part of your frustration, is that you don't know until you apply for the loan. Where on the census.gov, what website can you check for the eligible areas for the SPCP?
It's a great question. I think they're working on this. This is still a pilot program. Like I said, Fannie rolled out one and Freddie rolled out one. Freddie's is where you're moving to, not where you're moving from, but where you're basically moving to. And that's how they determine whether you qualify for the program. There is a map, not a great map, but there is a map that shows you the shaded areas that would qualify. But I've even asked for that. I'm like, well, at least give us the zip code so we can kind of know. But it's almost, you have to run it through automated approval engine to determine if you qualify for the SBC program.
And that's what I understood from you, is unfortunately it isn't as easy as just looking up to see if the census tract you're moving from qualifies. You really don't know until you apply, when you'll learn if the census tract you're moving from qualifies for the SPCP.
Exactly. I think another thing is you'd be best served if they can. Now, not everybody can, but if they can, because I don't want buyers to think, oh, this is just an easy, it's just like Fannie and Freddie. You're always going to get a better deal if you have the money to put down, if you have the 3.5%. Because I tell everybody this, listen, if you can get the 3.5% from even your own funds or qualified gift funds. Qualified gift funds can be a family member, a lifelong friend, as long as we can document it, they can gift that money. So the gift funds are the same as the borrower's funds, okay? It's always going to be a better rate, a better experience, a better turn time than utilizing down payment assistance money. Down payment assistance money is another layer of complexity. Not that it's a bad thing, but it's not to be replaced from having some skin in the game. If you have the ability to put 3% down conventional, or 5% down, or 3.5% down FHA, it's always going to be the better rate, the better price, the better everything. But if that's not an option, then you can explore down payment assistance. But I don't think it should ever be used in place of, hey, I want to put some skin in the game. Here's my 3.5%, or here's my 3%. Because unfortunately, this is another area where not just, hey, if I offer a Fannie Freddie loan is, with my pre-approval letter and I submit an offer, if you submit an offer that you're using down payment assistance, the reality of it is it kind of moves to the bottom of the list. I mean, they're going to probably take the cash offer first. They're going to take the conventional offer. They're going to take an FHA offer or VA offer. And then they would probably look at an FHA with down payment assistance. So it's out there. I think that might be changing a little bit, but that's just the reality of what I see. And, I do believe FHA is getting more attractive. They reduced MIP. There's talk, and I'm not saying this because I know anything, that they may minimize or reduce the upfront mortgage insurance premium. But I mean, I'm a point lower FHA over conventional right now on my rates. Get those closed in usually, 15 to 20 days. So it's a good loan program. It just has a stigma that people think it's going to get scrutinized on the appraisal.
I believe one of the concerns for sellers is they hear that if they allow their buyer to go FHA VA and they get a low appraisal, that appraisal will ride with the property for 3 months or 6 months, and they're going to won't be able to sell their property for if they're unhappy with a low appraisal. And I believe that's what I've heard expressed is one seller's concern about using government insured loans. If they get a low appraisal, then their property is, for lack of a better term, tagged with that appraisal for some number of months.
Well, that's true. That is a legitimate concern, and people have expressed that to me too. It involves around the appraisal. If it comes in low, that appraisal follows the FHA case file number, which is accurate. It does do that. So I'm not saying it's without merit. I just believe it's going to probably have to change a little bit because of home affordability, you're going to need we're going to need to start opening it up more, because not everyone right now is going to be able to, based on their credit score, the debt to income, primarily their debt to income, going to be able to credit qualify. So we're going to have to start opening a little bit to allow FHA buyers to achieve home ownership.
Tim, we've reached our hour. We're a couple of minutes past 2. Before we conclude, I'll ask you if you have any concluding remarks. But before I do that, I'll ask our participants if there are any other questions. I call it Stump the Professor time. So if our participants have any additional questions, feel free to throw them out now. If not, Tim, I'll give you a moment to wrap it up.
So I got a question. Tim, are you going to be forwarding your number on the after this podcast here?
Most definitely. Doug, what's the best way to do that?
If you'll just type it in the chat now, Tim. As a matter of fact, let me see if I've got your email signature, and I'll cut and paste it into the chat for everyone to pull.
Okay, I appreciate that.
The other thing is that we do record these presentations. We're going to post them on the YouTube channel. All the participants will get a link once it's posted, and we'll add that in the trailing credits on the YouTube as well.
I have a question. Hi, Tim. Deborah English.
Hey, Deborah. How are you doing?
I'm well. Thank you for asking. How are you?
Good. Good to hear your voice.
Thank you. Did you say that right now you're a point lower on a conventional?
I believe I am. Yes. Yes.
Okay.
I mean, I do price comparison with lenders, retail lenders. And I mean, I've been priced super aggressive, especially on the FHA side, but on the conforming side too. I mean, I'm, 30-year fixed, good scores. We're in the probably 6.375 range today. And on FHA, I priced one out the other day at 5.625. And again, all this was without any points. That's another thing. A lot of people will see these advertised quotes. Oh, 6.25 or whatever the rate is. Be very cautious of those, because it's usually the fine print says that includes 1 discount point. And
Right.
I do want to say one thing while Deborah brought that up. So here's another good thing. So think about it like this. If we can get somebody to go FHA or conventional, and they can put 3 and 3.5% down, okay? And we can work on just the closing costs and prepaids. It's still a seller's market. It's still slightly a buyer's, maybe y'all disagree, moving toward a seller's market. But many of the latest deals I've done include a seller concession. So, if we're getting DPA or not getting DPA on the front end, that doesn't really matter. We're going to try to structure the loan to offset the closing cost and prepaids by seller concessions. So be cognizant of that. If I'm doing a loan at 5.5 and somebody else is doing it at 6.5 or 6.375, and I can go up to, say, 6%, but me going up to 6% allows me to give a lender credit of X, say $4,000. Then I'm able to lower their closing costs or buy down their rate, whatever's the best, by giving that lender credit. So another advantage of a lower rate is not just your lower monthly payment, it's going to increase your buying power, because if they say, I'll go with, I already had a 6.375 from this bank, Tim, what is your 6.375 rate? That may be paying them back $4,000 or $5,000. It depends on the scenario. So there's a lot of structuring that can go in on whether you look to buying points and what your return on that investment is, or if we want to go the other way and say, my debt to income's okay. I'm okay on the rate. My biggest thing right now, Tim, is getting the cash to close as low as possible. So I work with all my buyers to really structure the loan so that we're meeting that. We're minimizing the cash to close if that's their pain, if that's their need, or we're minimizing their monthly payment. So there's it's not just one rate suits everybody or one deal. Every loan situation is different. I try to pride myself on really getting to know that person and figuring out the best loan program and, structuring something especially for them that makes it work. I'm often told, hey, I just closed a loan 2 weeks ago, and the lady was like, I've been trying for about 2 years and you got it done. Now and maybe things changed over that time period, but she was super happy that we were able to make it work. So, Deborah, I know that kind of in a roundabout way answered your question, but
Yes, thank you.
all right.
Tim, I added a shared screen to share your information. So is everyone seeing Tim's information on the shared screen?
Yes, I can see it.
Wonderful.
Well, is there any more questions?
Tim, there was one more. Do you do non-QM for foreign nationals?
We do. So when I say we do them, we have investors that do them. As a broker, I shop around and get the best. But yes, by all means, we have a foreign national program. And there's requirements and qualifications, but we do have a source to send those buyers that are looking to they don't reside here, but maybe they're looking to buy a property here or vice versa. They're looking to buy a property abroad. So we look at their whole situation and go from there. But yes, we do.
Tim, anything you'd like to add in concluding remarks, and we'll call it a day?
No, I appreciate this time. I appreciate the opportunity to speak to you guys. If I can ever be of assistance, even if you have a preferred lender, if you're working with someone else, just give me a call and say, hey, Tim, what's your thoughts on this? I 100% don't mind that at all. I'm here to try to help anybody I can. I appreciate the opportunity. Thank you, Doug. Sorry I had trouble with the PowerPoint presentation and the Zoom thing, but it was enjoyable and I appreciate you.
Everyone, thanks again for joining us on our Business Builder Speaker Series today. And tune in next month, May 17th at 1 p.m. for Steve Hanley from Georgia Pine on Georgia Pine Home Inspections on the importance of getting a home inspection to avoid costly repairs. And as always, I want to thank Tim for joining us. And for each of you, I want to wish you great success in your real estate ventures. And please let Tim Arrington or Doug Dean at Shafritz & Dean know how we can assist you in growing your business. And we'll look forward to speaking with you again soon. Thank you.